Are you paying taxes quarterly? Then real estate investment may be where you need to be, and that's what we're going to talk about today on Just My Opinion. This is Jessica Duncan's Just My Opinion, and I'm Jessica. There's no handbook to owning a home. That's why I go beyond the transaction to share my tips, insights, and opinion for adulting made simple. I'm so excited today in the studio. We have Rob Benson, and I do want to give you a warning. What we're going to be talking about today is very advanced. It is a lot of tax strategy. We are not CPAs. I want to make sure everyone knows that. We're just giving our opinion. Please reach out to the professionals. So I don't want to claim that we are something we're not. Me nor Rob are CPAs. We just have a lot of experience in this. And again, it's just our opinion. Today, what we are talking about is not for your beginning investors with your traditional W-2 1040 tax returns. We are getting deep in the weeds on how to have great tax strategies and minimize some of that tax debt through real estate investments. So this can be a little bit in depth of a topic. If you're not there yet, it's okay. Listen in. You may find yourself here in a couple of years, but this is some pretty in-depth strategies. And here today to talk about these with me is Rob Benson. I'm so excited to have you here in the studio, Rob.
So honored to be here. Yeah,
Awesome.
This is awesome.
So Rob is actually a loan officer advisor with Legacy Mutual Mortgage. And sort of weird how this came to be. We were actually working with a client together and talking about some tax strategy. And I said, oh my gosh, I love this. You know, I love my spreadsheets and get all excited about it. I said, I got to have you on the show.
Yeah. So happy to be here. And I think it's really awesome how a lot of the time, like in our industry, it's always a pitch. Like, how do I get you to have a conversation with me? But this was it was total business, right? I'm like, this is just what we advise our clients on. And you're like, we need this. So really happy to be here. I'm really even more excited about what we're going to go over.
So Rob, let's start before we dig into this tax strategy. Tell us a little bit about who you are and what your background is.
Absolutely. So like Jessica said, my name is Rob Benson. I am a mortgage loan advisor with Legacy Mutual Mortgage here in Pensacola. You know, the way I got into this industry, I think for this podcast, super relevant. So I was in the Navy and I was actually around just a bunch of like broke people, like that's what we'll call it, right? And I was there, so no shame. But just a lot of people not making a lot of money, but making even more poor investment and like savings decisions. And so I remember telling a mentor of mine, I think I want to be a financial advisor when I get out of the military, you know, and I really want to help people build wealth. And so I was kind of telling her my plan. I had like this super elaborate approach, like how can I become a financial advisor? Really, really altruistic mission for like helping soldiers and sailors build generational wealth, get themselves out of like a really, really bad financial situation. And she sprung this one question on me. She's like, don't financial advisors get paid based off of how much wealth they manage? And I'm like, yeah, never thought about that. She's like, how are you getting paid? And I'm like, light bulb, you know? I'm like, okay, I'm gonna need to fix this strategy a little bit.
So you told us a little bit about the military and your background there, but tell us about you personally. Tell me a little bit about your personal life.
Absolutely. So I am 30 years old. I have a wife named Taylor and two incredible wild children. Mia, she's 2.5, and then Rhett is 6 months old. We have a dog named Finn. And
I have a dog named Finn as well.
Way, this is crazy. The things that come out on the podcast.
Right.
So we love living in Pensacola. We came here and I had never even heard of Pensacola, but it's home. And I think it'll be home probably for the foreseeable forever. But we love it here. I love seeing the evolution of this area that we live in, and just what's happened in the last 10 years is crazy to me. Like
it is.
It's really totally been reinvented. So I love to work out. I love being good at my craft. So I think when a lot of people are like, well, I do this job, I'm successful at it, it's just kind of my gig. Like I actually do love I'm a student in the game. Right. I think that's the best way to say it. So
I think that's where we click too. We both love what we do. We love to dig in and learn more. We're not complacent in where we're at. We know that there's always more to learn. We always want to be improving our skill set, improving what we do to service our clients better.
Big time. Yeah.
Awesome.
Yeah. So I actually was advising a sailor who, like, terrible financial situation. She had just gotten a divorce and she had basically no money. She's like, I need to sell my house. I could make basically $150,000. And a light came on in my head. I'm like, people with a VA loan, they can buy a house for no money. The house just appreciates and they have a giant savings account. So they don't even have to really be good with their money. They just have to maintain the house and pay the mortgage. I'm like, that's incredible. And people overlook the home as a savings account or savings tool so often, but it is one of the biggest. I think the statistic is like, what, 99% of billionaires have built their wealth or built their empire using real estate to some degree, right?
Yeah, it's crazy. And, speaking of the military, I can't tell you how many times I have seen military do it right and military do it wrong.
Correct.
And those that get stationed someplace every 2 years and have bought houses everywhere and then turn those into rental properties have a total different retirement life
Correct.
than those who didn't. And they have such a competitive advantage with the VA loan that the rest of us don't have.
Correct.
Yeah. So that led you into mortgages.
It did. And so here we are years later. I think how we got on this topic is over the past 2 years, as interest rates went up from, historical low 2% to now we hit 5, 6, 7. In 2023, rates were even 8%. People will always need to buy homes to live in. But investors, it's kind of a different story. They don't always need to buy. They're typically people that are more savvy with their money, so they're waiting for the right time to buy. And they can hold out if they need to, because what will they do with the money they would put down on an investment property? Well, they'll just put it in a security or the S&P 500, like some sort of interest earning vehicle. So obviously there's been a ton of interest from investors over the last couple of years. Like the market has slowed. Can they come in and get a deal? But the number one thing we've been hearing from our clients is like, well, we just can't make the numbers work. I think you agree with me. I probably heard this 100 times over the last 12 months, like the numbers just don't work. So we went to the drawing board. We said, we want to work with these clients. Like we want to give them a strategy. We're not looking at the whole picture. Like there has to be a way to make this make sense for them. So we started really looking at, okay, most of the time, if we look at mortgage payment versus rent, that can be a bleak conversation.
And that's the front end. And that's what, it's so funny though. So many of the investors when I meet with, when I even ask them, so how are you judging your investment? What's your ROI you're looking for? They don't know. And a lot of them know that their CPA told them to buy real estate, but they really don't understand how to evaluate it. They're just looking at that front end. And I try and explain it to them, and I'm trying to get into it. And I'm not a CPA. You got to talk to your CPA, but look at this end of it. Look at this end of it. And so when we started having that conversation, I'm like, he gets it. He totally gets it. So definitely a tax strategy there.
Yeah, for sure. And I think it's funny, like we reached out to a few people, CPAs, over this time period where we're kind of scratching our heads. And alone, like they just didn't understand. It's like the client needs a really, really clearly articulated plan for what you've told them to do. The exact same thing, like go buy a property, go do this. But they didn't know how to deliver it. It was like when we teamed up with one of them and said, how can we both come together and you have a totally different skill set and knowledge base and I have the same thing, and like bring those together in unity and really figure out what is the best thing for the client here and how do we give them a clear plan.
So let's break this down. When we talk about the front end, what we're talking about is rents minus expenses, getting your profit. So you've figured out how much it's going to rent for, short-term, long-term, whatever it is, how much your revenue coming in is going to be. You have all the monthly expenses, HOA, mortgage,
insurance, cleaning,
whatever it needs to be. Short-term rental, the tenant pays the cleaning.
Sure.
But, we're going to take all those expenses out. And then we're going to look at how much you invested cash into the property, not the total loan. If you're financing, if you paid cash, then yes. But we're going to take that total number of out-of-pocket cash that you put into it, divide it by your annual profits, and then we're going to have your return on investment, right? And so that's your front end, right? That's what we're talking about on the front end. So that's how much cash flow are you getting annually on this property based on your return on investment. And sometimes that could or could not look good. As a general rule with our investors that don't need the tax strategies, so maybe more of our beginning investors or, they're looking a little bit more at just getting that cash flow. So we're having those conversations. But when you get into this level of complicated taxes, let's call it, or when you start paying taxes quarterly, you need a little bit more strategies, right? If you're paying taxes quarterly, this may be a good podcast for you, definitely. You've got to really start to get creative to avoid paying so much because you're paying at some of the highest percentages of anyone in the nation. And you don't have to be multi-millionaire to hit that tax bracket at all. So there's a big misconception there that people think, oh, well, if you're paying quarterly, you're a multi-millionaire.
No, not the truth.
No, not the truth at all. So you're not able to do some of the other things that people who don't have to pay quarterly are, such as certain types of retirement investments. You don't qualify for those anymore. There's things like that you can't do. So you have to get more creative with your money and make your money work a little harder for you. And so that's where this back end comes in. So let's explain a little bit, Rob. I'm going to let you take it away with what we call the backside or the annual tax benefits that we're talking about when we talk about this return on investment.
Absolutely. So if we were to kind of break down like quote unquote backside of this conversation, it's how do we use the expenses, everything you went over in your front end calculation, your HOA, your insurance, property taxes, all the management fees associated if it's a short-term rental, and just maintenance in general against, income, or to use that as an actual tax write-off. Now, I think that this is the oldest trick in the book for most investors, right? Is everybody's looking for a tax break. But again, much like you said, if you were to ask those people, like, can you explain your tax strategy to me? They'd be like,
no.
I have a really good CPA.
Exactly. That's my tax strategy. No.
Do you have a good CPA? Are you sure?
Yeah.
And we'll talk about that. But overall, I think it never gets communicated on the front end of the transaction, which is crazy because when you look at like difference between a millionaire and a billionaire, what is the actual difference? I think we talked about this, like their tolerance for risk. Right. It never changes. So those people operating at that level, they're looking at both sides of this conversation on every single decision they make. They want to know, yes, what does the front end look like, but also what does the back end look like? And I think the reason we're here talking about this today is when you look at the back end being the tax strategy, the tax advantages, it's an incredibly undersold part of the equation.
So let's just break it down real simple terms. So let's say they looked at the return on investment at the front end and they're only making 1 or 2%. Looks very meek. Doesn't look like a good investment. But then once they plug in that depreciation and all those deductions that for their expenses that they're going to be able to take, all of a sudden that money back in their pocket because they're not paying taxes. So maybe their tax liability, what they have to pay throughout the year, because we're paying quarterly, what they're having to pay throughout the year just reduced by $45,000.
Correct.
So that just added an additional $45,000 worth of revenue, really, because it's more money in their pocket, right? So that may have just taken that return on investment from 1 or 2% to 8 or 9%.
100%.
It's a total different conversation. And so many investors aren't looking at that. All they're looking at is that front end number, not that back end number. And so that's hard because you got to look at that. That's truly part of your strategy. Yep. And that's why so many CPAs tell people you need to go buy real estate. I can't tell you how many people call me and say, my CPA said I really need to buy real estate. Yep. And then as they're evaluating it, they didn't give them that strategy. And so they're going, well, this doesn't make sense. Well, I can't find anything that makes sense. So
Correct.
Their CPA is giving them the advice, but they need the tools to understand it as well, which is why we're doing this. Let's look at how do you do that and understand why you're buying it, so we can understand how to benefit you. I've had these conversations with clients for years and gotten pretty in depth with them and like, okay, well, if we hold it for this long and call your CPA, find out what your capital gains is. And, they love it when we do this because it's so in depth and you're really being that resource to them, not just trying to sell them something. So let's talk about how we're going to take those deductions so you can depreciate a property over the years. So you can take those depreciation benefits. There's a couple different ways, but depending on how many years you're going to choose to do that. But then there's also some strategies there around how you classify yourself. Let's talk a little bit about that.
That's right. If it's okay, let's just go through a brief breakdown of like actual deductions and like net loss, net gain.
And let's go ahead and clarify, make sure everyone knows neither one of me or you are CPAs. This is just our opinion, remember? So we are not CPAs. Please talk to your CPA. Your financial situation may be a little bit different. We're giving you a broad scope here, but it's just our opinion.
That's
all right, go ahead.
That's right. So the last client that we did this on was a $1.1 million purchase, and we've gone over these numbers together. And so the client would have made a $220,000 down payment, and that's really their only investment. When you look at even the closing costs or any of those fees associated with closing the transaction, like they're not 100% tax deductible, but they are able to be used as a deduction year one, right? So even that can't really be included in your initial investment conversation. It's just down payment if you're financing. And so when we look at the breakdown of fees, I won't bore you and add every single one of them up, but it's definitely negative, right? We very, very clear that you're taking a loss year one, or it's a very, very minimal gain, like 1%, 2%. And the key is that's cash on cash return front end. when we add in
and this situation is someone buying a $1.1 million condo on the beach that they're going to rent out, short-term rental that does very well. It is one of our most highest producing rental income properties on Pensacola Beach. So people are like, well, wait a minute, this isn't a crappy property. This is a really good property that is in very high demand. These units don't come up for sale and they stay rented. And you're telling me it's only going to give me like maybe 1% return?
That's right. That's right.
Why would people buy it?
So that's the dilemma that every single buyer has these last couple of years, right? Is they look at the numbers don't make sense at the front end. So you have to encompass the entire conversation. And this is where the rubber meets the road. So when we add in depreciation, which we call in our industry, it's a fake expense. If somebody claims depreciation on their taxes, it's not something they actually paid for, but the IRS gives you that as a tool to be able to use it for a deduction.
And let's talk about that. So as an investor, I'm going to depreciate and lower my income, and then I want to buy more property. How are you going to look at that? Did I just lower my income to hurt me from buying other property, or is that going to be taken into consideration?
That's a great question. I think there's a couple different ways we could go with this as well. So let's start by saying, number one, in the last couple of years, there's so much of an advent in technology and products in the loan space. We have a loan program for every single person in that situation, whether it's a no-income investor loan or something like a DSCR loan where we are solely using to qualify the client rental income versus mortgage payment. There's definitely a tool or a product that we can use to help negate the effect of that. But the income level that we're talking about in this conversation, most of these people are, believe it or not, going to be pretty unaffected by making even a $66,000 write-off yearly. It's really not going to scratch the surface unless they go to buy a home that's like 8% or 8 times their gross annual income, right? Which most people at that income level are not doing. So I think it's going to take multiple, and I'm talking 5, 6, 7, 8, 9, 10 properties to get to the level where you're actually like no longer able to get, what's the right word is leverage, right? Leverage anymore with loans. But that's a really good question. So yes, you are claiming a loss. It's all about how you use it against your income, though. And that's where we're talking about. The key is it's not necessarily a net worth conversation. It's not necessarily a I make this much conversation. It's about sheltering income. If you are a person who needs to find a tax sheltering strategy for your income, then this is for you. So numbers, do you want to go?
Yeah, let's do it.
Cool. Okay. So when we look at adding the depreciation into actually like a very, very small gain or a very, very small loss, even on some properties, the number one objection we get on condos is the HOA, right? The HOA is so high. Well, the HOA is a tax deductible expense, and that's the way you need to reframe it. So when we talk about adding all these numbers up, you could be seeing anywhere from using the depreciation and all of the other deductions, which are expenses on the property, anywhere from a $30,000 to $66,000 loss on an average $1.1 million property. So to a lot of folks, that might sound crazy. Like, why would I claim that much of a loss on my taxes? Well, for the people who can afford these properties, they're paying like hundreds of thousands of dollars a year to the IRS in taxes. This gentleman particularly did really well for himself, over $500,000 in taxable, like actual taxes that he paid into that year, right? So I would call him dying for an investment property like this. Like he's bleeding chips. But that makes this one of the most strategic ways legally that he can offset the amount of taxes that he's paying into. This is legal tax sheltering.
And let's not mention the fact that it's also growing in value. His family gets to use it some. Like, there's a lot of other perks that go along with this besides the taxes. But so continue on. How is he going to use this to really reduce his tax debt?
Absolutely. So when we add all the numbers together and we get our loss using all the deductions, putting the depreciation in there as well, we're talking about there's 2 different ways that you can actually apply this, right? And so the IRS classifies people as a real estate pro or not. And really all that comes down to, there are some rules around it, which is why we say, this is our opinion. Really, you need to consult with your CPA. But somebody who is a quote unquote real estate pro is somebody that has an LLC. They are a quote unquote, real estate investor.
They don't have to have a real estate license.
That's right.
They just have to spend so much time a year.
So much, 750 hours a year.
Working on real estate, working on their investment strategies.
Working on Zillow is what I think this would be for a lot of people. And so formation of an LLC, they can title the property in LLC. We do loans where they can vest the loan and title the property. That everything's done in the LLC. So it takes all the liability off them, number one, but then they're actually able to actively use the loss against the amount of income taxes that they owe for that year. And that's the key. Real Estate Pro, in quotations, we would say LLC or not. When you have the LLC formation, that's where you're able to do what's called active tax sheltering. So basically, you take $1 million earner, 37% tax bracket. Well, we know they're going to pay into that max tax bracket for that year. But if they have that LLC and they're claiming this loss, they're able to literally take that loss and apply it to the amount that they have paid into over that year and get that money back. And that's where that is a 100% cash on cash return for the back end conversation, right? Not the whole property, but it's dollar for dollar. They're getting all that money back using this write-off strategy.
So let's talk a little bit more about what we're doing here. So you have a personal tax return.
That's right.
You also have your LLC, and you're probably doing some form of K-1 distribution or...
This can be as simple as a Schedule C.
Okay.
And so we're really getting into the CPA lingo here, and I like it. Schedule C is still on the 1040. So we do have clients that they end up creating a partnership, or maybe they have kids that they want to include in these investment making decisions. So they'll create a partnership with their kids or their spouse. And that's when the K-1 would come into effect here, or they could even do an S Corp if their CPA advises that. I think the key here is like everybody's tax situation is different. That's where their CPA is going to be the person. You either need a Schedule C, or you need a partnership, or you need an S Corp, but they're going to be able to advise them correctly.
And that's where having that team in place makes 100% difference, right? I can tell you before I buy a property, I'm on the phone with my CPA going, what do I need to do here? Before I start another business, what do I need to do here? How do I need to set this up? How is this going to affect me? I call her all the time. I mean, hey, I'm going to buy this. What should I do? Yes. And then on top of that, you also got to have, how am I going to finance this? So I'm on the phone with the loan officer. Hey, what should I do here? How should I handle this? Even down to filing my taxes at the end of the year, I know what my goals are for the next year. So I'm like, hey, I need to make sure I show at least this in income. Like, we don't want to take too much off because I got some things I need to do this year. Maybe I want to buy an apartment complex or something, and I need to be able to finance some larger things. So they all work hand in hand together. And it's not, for me, it's finding someone who understands my goals long-term, not right now. And so even with the CPA, sometimes I've grown out of my CPAs over the years. I have a great one now, but over time I seem to grow out of them. When I ask them questions they can't answer, I'm like, oh, you're not my CPA.
Your return gets, I know what you mean.
Exactly. But, a lot of them, they just want to think about, well, how can I get a deduction this year? It's not always about this year. Sometimes it's about future planning. I don't want to make a decision on a 1-year basis. That's short term. I want to make a decision based on long term. And so sometimes I need short term and sometimes I need long term, but I need a CPA who's going to understand that, and a loan officer who's going to understand that, and a real estate agent, got one there, that's going to understand that and help me build these strategies. And there's so many times I meet with these clients and they don't have a strategy. And so we're having to really walk them through, here's what a strategy looks like. So we've talked a little bit about the tax strategy. We've given some examples here of how front end and the back end are going to benefit the client and how we really have to look at the entire situation. We've talked about whether or not they should be a real estate professional, Schedule C, Schedule E, a couple different options there. Now let's talk about the future gains. So let's get into this whole 1031 exchange. Do we worry about that? Do we carry losses? We have to look at, when we go to sell this property, what is our situation going to be?
Great question.
So I know you've got some great opinions on carrying over some losses. Tell me, when is it a good time, in your opinion, that we should carry over losses instead of taking them this year?
That's a great question. So I think that is the second option in terms of how you can strategically set up these tax deductions. So you're either a real estate pro, or the difference is it's going to be Schedule C, or a business is where you're funneling this through, or it's going to be on Schedule E, which is for passive income and loss, right? So the difference is using the tax benefits this year or using them later. And that's what your Schedule E is going to be. Now, contrary to popular belief, I think in the entrepreneurial business world, everybody knows you basically have 3 years to claim a loss on a business, and that's it, right? Now, with Schedule E, because it's passive income, you can claim a loss indefinitely. 100 years of your life, you can claim a loss on that Schedule E. Obviously, that's going to affect your income pretty minimally for most people, for something like going to get a mortgage or applying for a business loan. But the point there is, it's do you want the right now tax advantage, or do you want to kind of look at the long term And how can I use this down the road? And that's where we start talking about 1031 exchanges and capital gains and things like that. So when you are carrying the losses over, the main purpose of that strategy is to be able to use these deductions. I call it the IRS savings plan, because it stays there in the ether until you use it, right? So let's say you do end up selling that property within 2 years or even a primary residence. You kind of have this IRS quote unquote piggy bank where you can actually use these deductions that you have claimed against whatever that taxable income would be. There's a lot of people in these situations, they're even able to eliminate, if not completely minimize, their 1031, like the need for a 1031 exchange, because they're not having to pay capital gains. The same goes really for certain liquid investments like interest
and
earned.
Hang on, let's explain what a 1031 exchange is, just in case
Great.
no one knows what that is. What is a 1031 exchange?
So a 1031 exchange is essentially a tax, I don't want to say shelter, but tax deferred vehicle.
Yeah. I say you're kicking the can down the road.
Correct. That's right. Yeah. You're not paying capital gains on an investment you are selling or liquidating now.
So let's say I'm selling this investment property. I'm going to turn around and put that money into another investment property. I'm going to avoid capital gains by doing what's called a 1031 exchange. So I'm going to put that money when I sell it into an intermediary that's going to hold it. And I have so many days to identify the property and so many days to close on the property to avoid capital gains. So I'm investing it from one to the other, not really ever taking possession of the money. Therefore, I'm avoiding capital gains. But there's some rules around it. It's got to be like-kind property, things like that, which gets really difficult sometimes if you're especially going from investing in one state to another state that 100%. Maybe there's not like-kind property. So there is some, limitations there. But so 1031 exchange, that is what it is for those that didn't know, but continue on.
Yeah. So essentially you look at, do you pay capital gains or not on this investment that you're selling, or maybe it's investments you've sold off, liquid investments I'm talking about. If it falls under the category of capital gains, even if you were to have like a primary residence you sold within the time period and you incur having to pay capital gains for that tax year, you can use these long-term, rolled over losses against that to directly minimize the amount of capital gains tax you're paying. And so that's where, whether you make these deductions in the current year you're having your taxes filed, or down the road, you're still getting a return on investment.
So let's say maybe I bought a new investment property this year, bought a beach club unit, and we're renting it out. But maybe I really don't want to take those deductions right now. I'm going to roll that over for a couple years because I know I'm going to sell my primary residence. Smart. And it's going to exceed the limits on what I can avoid on capital gains, because you can sell a primary residence and avoid capital gains, but there's limitations on, I think a married couple's $500,000. So if it's over that, there's going to be a huge tax liability there. So if I know I'm going to do that, I can be strategic and start taking those deductions as a piggy bank and rolling them over, not cashing in on them now, but rolling them over for when I sell that primary residence in a couple years?
That's exactly right. Yep. And so that's what makes it so much more of a conversation than just rent versus payment, is we have to look at how is this affecting you for even years to come in for some people, right? And we're not talking about a $5,000 or $10,000 or $15,000. This could be hundreds of thousands of dollars in tax benefits, either over a course of many years or even just based off of one property after a couple years.
Yeah, because, capital gains, we're talking between 15 and 25%.
Correct.
That doesn't include your actual income tax, because it did increase
Totally
your income. So this is on top of income taxes. You're now paying an additional 15 to 25%, depending on short-term, long-term, things like that, of your profits, right?
Well, the part that most people also forget is how many times do you see a client that they go and sell like an asset or let's say a property, and the capital gains actually puts them into a higher tax bracket, right?
Right.
Really
so
common.
They could be in one tax bracket and then they've sold something and now their income has increased into that tax bracket. And then they also have the capital gains.
Correct.
So you have your income tax at that new tax bracket, and then you'll have the capital gains to 15 to 25%, depending on whether it's long-term or short-term. That's a whole nother tax that we weren't considering here, right? So these are definitely some great strategies. And, for some of our listeners, this may be very complicated. It doesn't have to be, right?
Nope.
I think the biggest key is to talk through what your strategy is. And if your CPA tells you, go buy a property, why? What am I trying to achieve here? What do you want me? Put me and the lender and Rob in touch with that CPA, and let's figure out what we're trying to achieve here so we can find the right property that meets those standards. And I could help so many more investors if they just knew what their strategy was, because a lot of times that's the biggest question they can't answer is, I don't know. I don't know what I'm trying to achieve here. I just know I need to buy real estate.
That's right. And I mean, it's kind of ironic, I think, how you're very successful in your line of work. I'm very successful in my line of work. People don't talk about this. And that's what I think is so unique about this strategy is this is not rocket science. And we definitely have not invented anything new here.
No.
This is something that's been eligible for people to take advantage of for a really long time. But it's the matter of having the right team. And I think that's what you're trying to drive home. Having the right real estate agent, having the right lender, having the right CPA, and even the financial advisor sometimes is going to need to be a part of this conversation.
Absolutely.
Making sure everybody's all in unity. Granted, not everybody's going to have the same opinions, but I think at the end of the day, all those people, I know you, especially the way you run your business, you have the client's best interest in mind.
Always.
And that's what we're trying to explain here is we're just trying to get people to open their eyes to, yes, this is still a good investment. Yes, this is still a good investment decision going to buy this property. You just have to look at the whole picture. And I know one thing that we were talking about going into this is very, very multi-layers of the conversation, right? And it's very detailed, and we're talking about a lot of different strategies and approaches to this, but it really comes down to this one thing, like what investment vehicle, where can people put their money? For some of these clients, we're using things like interest-only loan products. So every cent that they're contributing to the property, it's all tax deductible. Right. So what investment vehicle can they put their money in where you can't even be taxed on the growth, which is the appreciation side of things? We haven't quite gotten there yet, but it really is true. It's a 100% tax deductible asset that is growing in value, and you're not even able to be taxed on the growth.
And that's huge. So a lot of people don't understand that. But what we're talking about is you have that asset. So let's talk about this beach club unit we were talking about. So that beach club unit is growing in value.
That's right.
Annually. There's some stats there.
We'll be conservative.
Yeah. So
4.4% is the national average. Now, granted, where this property is located, we do experience higher appreciation. Right?
Absolutely. Scarcity. Anytime you have scarcity, you get an increase in percentage of growth, right?
Easy
it's
math.
A rare product.
Let's just talk national average, 4.4%. Right. So, literally this property will appreciate over $40,000 in 1 year. If you had that money in a mutual fund and it appreciated the same amount, you're paying taxes on that income. But why are you not paying taxes on the property if it appreciates?
And this is something, though, that was really huge in the last presidential election.
Correct.
That they were talking about, where they wanted to charge us taxes on this increased assessed value, or it's not even assessed value. I don't even know how they were going to determine it, but the increased appreciation. And my mind was boggled by that. Right. I'm like, how in the world are they going to figure that out? A Zillow estimate or what? Because we know how inaccurate that is. But luckily, we are not taxed on that. So you have all these tax strategies and benefits you're getting off the property. You're getting the income, you're getting the front end income, you're getting the back end income. But then you also have that asset that is growing in value year over year. So you have a whole nother income that comes in when you sell that property, right? Correct. There's a whole nother growth there or return on investment there that we haven't even calculated. Nope. We've done the front end, we've done the back end. We didn't talk about when you sell it and the appreciation of that property. So you have even more. And then you got to get into some more tax strategies there on what you're doing with that. So there's so many different ways to look at the return on investment of these properties that's not as simple as revenue and expenses. And that's where we really have to dig in with the customer. And you'd be surprised though, customers, they're like, I don't know. And so when we have those customers that will really open up and share their strategies, share their tax information, it's very personal and you got to trust these people, right? Yeah. They're going to have to share their income anyway with you, right? So you have to see those tax returns. So it's a lot easier for you to have those conversations. Where with me, when I start digging in, I'm like, well, you know, how much taxes are you paying a year? What are you writing off? They're like, huh? Why are you asking me that, Jessica? And I'm like, well, I want to help create this strategy. Because like you said, I'm not looking for making a sale right now. I work 100% off referral, and I'm able to do that by taking care of customers and they refer others to me. And so it's not about making a sale right now. I want to be their advisor for life.
Love that.
And I want to be their whole family's advisor and their children and their grandchildren. Like I want everyone around them to be like, no, she's the one our family uses for real estate, and here's why. So it's not about that one transaction. And there are times where I just had a conversation actually on the way in here, client talking about should they rent out or sell their current house. They don't need the money. They've built another house. It's in a great area that's going to continue to grow. And when I looked at the front end return on investment right now, renting it out is 10.59%. holy crap,
Yeah, that's high.
why would you sell that? And I'm like, I wish I could get that on a front end right now. I
Right.
can't find properties that are giving that.
You're hard pressed to find any investment right now to pay that out,
Exactly.
consistently. Yeah.
And it's in an area that I think is going to grow more than the average of 4+% per year. So I think it's a great investment product for her. She doesn't need to sell it. So I only make money when she sells it.
That's right.
She's going to rent it out and keep it, long-term rental and short-term rental, because of how the property's set up. She'll be able to do both. I'm not making any money off this. I'm telling her to keep it.
Good
but
advice.
This is probably like our 4th or 5th transaction together. Her whole family has done business with me. Her daughter's done business with me. I'm going to give them the true advice that they need, because they're going to come back to me in the future for that.
Right. Yeah. I think you and I have spoken about this offline a lot, and we don't have to sell people on this strategy because it's just facts, right? And that's when you can deliver somebody. I always say good people deserve great advice. I heard that from a mentor of mine at one point. And that's what creates the sustainable business. That's what creates the long-term relationship. When you have the ability to, yes, make a sale, make a profit off of somebody, but when you give them the right advice, that goes a long way for people. And they're able to see you're not just somebody here for the transaction. Like, I do want to be your loan officer for life. I do want to be your realtor for life. You're creating a really, really safe space and showing them, hey, yes, I'm happy to work for you. I'm happy to list this property, but you have a fantastic investment here that I think you should hold on to. In the long term, it may not be what they wanted to hear right then, because maybe they needed to sell that property, like whatever the motivation was. That's going to go a really long way for them, though. When you think about multi-generational wealth, how that property is going to appreciate if they hang on to it, down the road, they're going to look back and be like, you really have my back, Jessica. So
absolutely. And that's what I always tell people. We go to work to make a living. That's paycheck, make a living, got to pay the bills. But we buy real estate to build wealth.
That's right.
And they are two totally different things.
Yep.
Making a living just means you're paying your bills.
Active.
Building wealth is where you and your children and generations after you don't have to worry. It's where you can live a retirement lifestyle that you can enjoy. It's where you get to reduce the fears that a lot of people have throughout life of how are they going to be taken care of in their older years. So very, very different strategies. Go to work to make a living, buy real estate to build wealth. And I'm a big believer that anyone can become a real estate investor. You can start small. It doesn't have to be these huge investments like we're talking about right now. There's always a starting point to get to there, right? I bought my first house at 19 and turned it into an investment property. So you can do it. It doesn't take a lot. I didn't inherit a bunch of money or anything like that. People always think that. No, I did not inherit a bunch of money. It was a lot of hard work. But there are so many first-time home buyer programs. VA has such a huge benefit on some of these. And so there's a lot of ways people can really get into this to work themselves up to these type of situations where they're having to create tax shelters.
That's right. And I'm so actually glad that you went there, because I think it's worthy of talking about for a minute. Like, we're talking about a very, very strategic approach to the tax strategy, but this really can be used for a lot of people. And I think the misnomer is, well, it's actually so hard to buy any property like that. And it's nothing could be further from the truth. I think I can personally speak for, my industry. The advent of technology and how many loan programs are available now, you can start out buying an investment property with as little as 15% down. You can buy a second home with as little as 10% down. When we get into the condo conversation, it's a little different. Sometimes higher down payments are required.
And especially here, because we have condos on barrier islands that are high risk, that are
Leasehold
leased
and
land.
like that.
So what we mean by that is technically on some of our islands around here, you don't own the land. You lease it from the government for 99 years. So it's leasehold land. So that gets very complicated. I love when customers call me and they want to buy a condo or a house out here. And I'm like, well, who are you banking with? I'm like, these large national lenders. I'm like,
they're not familiar.
You need to tell them that it's a barrier island on leasehold land and see what they say, because most of them are going to run from it. You have to have someone who specializes in this.
Right. Yeah, and if you're not active in that market, even as a lender, you really don't know the lay of the land, is what I call it, right? The HOAs, what's going on with them, what type of decisions are being made. It affects the loan, and it can create for a really good or bad client experience depending on who's handling that loan. When you go and look, and this is what we hear from a lot of our investors or clients in general, like you buying a home at 19, I guarantee you did not Google what is the minimum down payment. You went to a professional.
Well, there wasn't a Google then. Am I telling my age?
I wasn't
Actually,
I wasn't going to go there.
I did get my first computer with dial-up maybe
That's
3 months
funny.
before I bought my first home.
Check it out.
Yeah.
Check it out. Wow. So, I mean, even if that technology were there, I guarantee you had a conversation with somebody and said, what are my options, right? And that is a major, major point we want to drive home is don't leave this conversation or leave this podcast and go chat GPT. What's the best investment loan for me? You really need to have a conversation with Jessica, myself, reach out to one of us. And I call it a qualified conversation from an industry professional. We've made it really clear. We're not explaining some new strategy here. This is all just facts and it's all real data. So we're trying to give you all the tools you need to succeed, but you don't know what you don't know until you know it, right? So,
And there's a lot of assumptions made that aren't always true.
correct. And so much of the time, and like with just how much information is out there, how many podcasts, how many YouTube videos, everybody's trying to grow their presence and their following. Those people are not always giving advice for your situation. And that's really the key, right? When they talk about, I'm doing this investment property, I bought this property as an investment with 5% down. Sometimes we pick up these misnomers and it can really create a bad experience for the client because they have the wrong expectations going into things.
Absolutely. And that's a key. I think that both of us do. We sit down, we understand their strategy, we understand their expectations and make sure we're setting them up for success and ourselves up for success. If they've got expectations we can't meet,
right,
that's not going to be a good experience for us or them. So we want to make sure we're setting them up from the beginning.
Exactly.
So we have talked so much today about investments, tax strategies,
All of it.
how to get into this, the front end, the back end, the long-term gains that you're going to get as the asset grows in value, how to carry over losses. This is a lot.
It's a ton.
So if anyone has any questions and wants to talk more about these types of strategies, can they reach out to you?
Absolutely.
How can they find you?
Great question. So we are on social media. My Instagram handle is Rob J. Benson. We're on Facebook, Rob Benson Team at Legacy Mutual Mortgage. Our website, robjbenson.com. There's multiple ways to reach out there. Or honestly, every single client to this day, even after we've grown, text me on my personal cell phone. My number is 850-860-2090. And that is really my cell. If I had it and hadn't forgotten to bring it in, I could show you guys. But I do think
it's funny how we give our cell out and people are always shocked. I get clients that'll text me and go, hey, so I have a customer I want to refer to you. Can I give them your cell phone number? I'm like, yes, please do. It is everywhere. But I think that just speaks to the transparency of how we do business. We don't even hide behind a business line.
Don't want to.
You can get us any time of day pretty much. I mean, it does go on Do Not Disturb from 10 to 8 a.m., 10 p.m. to 8 a.m.
Right.
But I do that so that if they have a question in the middle of the night and they can't sleep, text it, get it off your mind, go back to sleep. I'll deal with it first thing in the morning. But it just speaks to the transparency that we have from our clients, I think, and the level of service we give.
I think it's a passion thing too, right? A lot of the time, and no shame for anybody listening that you have a business line or something like that, but I want to be involved and I want to personally have, not to an unhealthy extent, but like, I have a good team. They're very effective. They stay in their role. I stay in mine. Sometimes I want to get too involved, but I do want to have that personal approach with all my clients because this is my passion. And I want to make sure like, hey, everything is going well. You're getting the information you need. Are we serving you the way that you need us to, right? Are we giving you the resources that you need to be successful? And that's part of it. So I love that about you as well. Yeah. Personal sell.
So I love this. If you want to talk more about investment strategies, tax strategies, really want to look at your portfolio and find ways, please reach out to me. If you are not in my area on the Gulf Coast of Florida and you need someone in another state, city, don't hesitate to reach out to me. I will find you someone good there. Interview them myself and make sure they understand what we are talking about because this is more than just buying real estate. It's very in depth and we want to be that partner along the way with you. So we'll find you someone. Just DM me. You know where to find me. Jessica Love Duncan. Just Google it. You can find me anywhere, right? And if you have any more in-depth questions, please DM us. We'd love to talk about them on the show and we may just mention you on the show. Thank you so much, Rob, for being here. Before you go, though, we got to talk about home hack. So every week I do a home hack. And so a home hack is just something that makes life easier related to home ownership, investing, things like that. It can be an app, a spreadsheet. This week, I think our home hack, based on the strategies we've been talking about today, has got to be your CPA. That is the number one tool in your back pocket that you need, is that really, really good CPA. If you want to know who mine is, DM me. I will share her name. I'm not going to put it out here, but I will absolutely share her name and information with you. She has been a game changer for me. And there's some questions you really need to ask your CPA. You need to, be prepared to make sure you're getting the right one. And some of those key questions that I think are important are, if I get audited, what do I do? I want to know that they're going to be by my side because they understand this more than I am. They're telling me what to do a lot, right? So I want them by my side. I want them talking to the IRS, not me. The other thing I want to do is ask long-term strategies and figure out what their answers are. Make sure they can come up with those answers pretty quickly. I mean, sometimes they have to go do some research, but I want to make sure they come up with a couple options. Here's your pros and cons of each. Make sure you're able to have those good conversations with the CPA. And part of that home hack Rob is going to contribute to today. He has 6 questions you should ask your CPA. So if you DM me or Rob, we will get that over to you. That way you know how to make sure that is a good CPA for you and going to help you.
Awesome.
Thank you so much for being on the show today. This has been amazing. Any final words you want to leave anyone with?
Such an honor to be here. And I think the main point I want to drive home is, truthfully, anybody can be a homeowner. Anybody can be an investor. Yes, there's rules and there's regulations and guidelines and all those things, but all you have to do is just take the first step. You just need good advice. And so reach out to one of us if you have any questions about how to just start that process. And the truth is, yes, we're talking about these investors, but we work with people in all sorts of financial situations.
Absolutely. This has been Just My Opinion. I'm so glad you joined us. If you have any questions, please DM me. If you have an idea for a show, send it to me. We may actually ask you to come on the show or mention you on the show. Make sure you subscribe on whatever podcast series that you listen to this on so you never miss an episode. See you again soon for Adulting Made Simple.